Welcome to the Get On Point Business Podcast, where I talk with entrepreneurs, founders, and business owners to explore their journeys, lessons, and insights, as well as uncover the stories behind the successes and challenges of building a business. I'm Jason Mundy, a certified focal point business and leadership coach, business growth advisor, and a marketing consultant. I'm also the founder and president of On Point Business Advisors. Today, I'm excited to welcome a great guest and inspiring entrepreneur, James Tavares. James is the co-founder and managing partner of Bespoke Fiduciary Advisors, an investment fiduciary specializing in goals-based financial planning for individuals and retirement plan design for business owners and their employees. James majored in business economics at Brown University, and in addition to managing Bespoke Fiduciary Advisors, he is the president of the Cape Verdean American Community Development Center of Rhode Island, a youth soccer coach, and an amateur chef. Wow, we have a lot to unpack today, James. I know there's more to your background that we can get into. First of all, thank you so much for being my guest. I've wanted to have you on the podcast for a long time, so welcome to the show. Let's dig in.
Yeah, thank you for having me, Jason. I'm excited.
Excellent. So tell us a little bit more about yourself. Tell us, about your background, what I didn't cover, and then what inspired you to start your business and embark on a journey of business ownership and entrepreneurship.
Sure. So I am a native Rhode Islander, born and raised in Providence, moved to Cumberland, Rhode Island when we were 5 years old. And for the first, call it 25 years of my life, I don't think I left a 5 mile radius. Went to school in Cumberland, went to college at Brown, as you mentioned, in Providence, and started my career at Fidelity Investments in Smithfield. So I stayed very close to home, which was a great experience, as you know.
Mhm.
In Rhode Island, it's parochial, right? It's all about who you know and building strong relationships. So that was fantastic. My family are Cape Verdean Americans, which is why I'm the president of Cape Verdean American Community Development (CACD). My
Very cool.
mother came to the United States in 1980, just before my family had me. So I'm generation 1.5. My dad's family
Wow.
started immigrating to the U.S. in the early 1900s, but it happened in waves. My great grandfather was a sailor. He came over first. The rest of the family stayed back in Cape Verde, would send some money over, and then little by little, they got the immigration go ahead to come to the United States, and that was a huge reason as to why I ultimately went into financial services. And I know we'll talk about this down the road, why I started my company. But it had a
Mhm.
lot to do with the fact that we came here to realize the American dream, right? And that's
Mhm.
home ownership, being able to, build some wealth, build generational wealth, and then use that to benefit your family and your community. So that's always been an important part of who I am. I remember growing up going to all of the Cape Verdean festivals and learning the language and the food and the music. So it's inspired me to do a lot of what I do in my community service.
That's amazing. I mean, that's the American dream, and certainly in this part of New England, Rhode Island, and southeastern Massachusetts, right? There's a very large and strong and thriving Cape Verdean community.
Absolutely, yeah. We're quite strong here. In fact, I don't know how much you want me to bore you with Cape Verdean history, but Cape Verdeans actually started
Sure.
coming to the U.S. In the 18th century. So there's documented Cape Verdeans that fought in the Revolutionary War for U.S. independence.
Wow.
All goes back to the fact that we're mostly sailors in the homeland, and New Bedford, Providence, big whaling community. So
Mhm.
Cape Verdeans came over to be whalers and try their hand in that.
That's awesome. Yeah, it's such a rich heritage. I see it everywhere. So that's great. And it's awesome that you're so committed to it and that you give back to that community and continue to, maintain those ties and that heritage.
Yeah, yeah, it's important, and it ties into what I do with work as well, with the financial planning aspect of things. It's a lot of what we want to do. Our company is actually a public benefit corporation,
Mhm.
so we were founded with the idea of it's not just about a profit, but to do a public good. And we do that. We hit that mission in a number of different ways. We do a lot of pro bono work. We do a lot of financial literacy at the center, with the idea that, let's help raise our community up. And financial planning, financial literacy is an important part of that.
Awesome. I think that's excellent. So speaking of financial planning, it's in wealth management. It's a pretty nebulous and broad category. I think what I've learned from talking with you and others that maybe it's misunderstood and there's a lot of misconceptions about it. But what does retirement planning mean to you?
Yeah, it's a great question. Um, for me, for our firm, what retirement planning is really all about is sitting down with a client, an individual, if we're talking to the individual, and giving them some clarity, clarity on the feasibility of their goals. Retirement is never what it looks like in the commercials. Most of us aren't retiring on a yacht on our private island, right? So you see that in all the commercials. You're 62 years old and sun-kissed and on your own private island. That's not the
Oh
reality for most
man,
folks.
really?
I mean, I don't, I maybe for you and for a lot of folks out there, but for the majority of the population, it's knowing that at some point in your early 60s, early 70s, maybe you've had enough of working at least full time, and you need a plan for how to draw down your assets. So the biggest misconception that we found in our business is the idea of what risk is.
Mhm.
So when we start talking about putting together a plan, the conversation, mostly the clients will always take the conversation down to investments and what type of investments can I need and what sort of risk can I take in retirement. And the flaw with that is risk. When we talk about risk in a portfolio, we're normally talking about market volatility, market risk, right? Which is A, not something we can control, but B, not what you should really be concerned with. The only real risk anybody has is the risk of not accomplishing their goals. So if your goal is to retire at 65, and the big risk there is that you'll run out of money at some point before you pass away, right? And so if you're figuring that the 50% of 65-year-olds retiring today are going to live into their mid 90s, you need a plan that will cover you for 30 years. And so when I think about the misconception of retirement plan, it's around retirement planning. It's around all of the old rules and heuristics: withdraw 4%, have X amount of your portfolio in bonds, make sure that you're only touching Social Security at this age. And in reality, those don't apply to most folks, right? So the misconception is that retirement is uniform and that we're all going to be on a beach. It's really an individual conversation centered around your circumstances, and then building a plan to give you the highest probability of not running out of money, which is risk. I don't know if that covers it, but it's
Got
something that we talk a lot about,
it.
understanding what risk really means
Mhm.
and how you fit that into your goals based plan.
Got it. That makes a lot of sense. I mean, those are hard conversations, but they're ones that need to have to happen, and it's the reality.
Yeah,
Yeah.
absolutely.
So, James, when we were preparing for this podcast, you told me you were like super busy. You told me your inbox was like blowing up over the past week or week and a half, with questions from your clients about the tariff wars that are going on. So, tell us more about that. How does that affect your clients, and what are they concerned about?
Sure. Yeah, it has a material impact on our clients. And what they're concerned about is the introduction of market volatility, and then how that market volatility impacts their financial plan, right? So, what we do as a goals based planner is that we try and give our clients the best chance of meeting their goals. And we use some planning software to do that and come up with some probabilities. And a large part of getting to your goals, and this is another sort of misconception around the industry, it's not about how much money you make in an up market. It's about protecting yourself in the downside, right? So we talk a lot in our business about the benefits of compounding, the eighth wonder of the world, right? But what we don't educate folks enough about is the impacts of reverse compounding. So what happens if you lose 20, 30, 40%?
Mhm.
The gains needed to recover from a 20, 30, 40% are exponentially larger on the upside, right? So I do this with my clients all the time. I tell them, pretend you had $100 and you made 10%. How much should you have? And 110 is the answer. And then you make 10% on that. How much should you make that next year? And it's 121, or you made $11, and that's the benefit of compounding. But think about it in reverse. If you had the 100 and you lost 10% in year one, you're down to 90. Well, if you made 10% the subsequent year, you're not back to whole, because 10% of 90 is just the 99. So that's what we talk about with reverse compounding, and the effects are exponential. So a 50% decline in the market requires a 100% return on the upside just to get back to whole. 50% declines happen. We saw them in 2008. That was a peak to trough of right around 52%. But 100% the following year doesn't happen, right? So when our clients start worrying about tariffs, it's because they understand that having losses in their portfolio will elongate their retirement plan, and we want to protect them from that. So, in terms of what happened, so that's why they ask. So, in the what happened,
Okay.
um, this is something else that's happened in a post 2008 environment, where um, we got rid of a large portion of the big banks, right? You remember the too big to fail deal. So we broke down a lot of the big market makers. And in doing so, we protected the economy and the financial system from having two or three huge institutions that, if they failed, would collapse the entire system. What we didn't realize at the time is that those companies acted as market makers. So when we had a period of volatility like we saw with COVID in 2020, and the markets were in an extreme sell-off, these big institutions would kind of step in and calm everybody down, and they do that by buying up all of the securities that were being sold at a discount. So it kind of prop up the market, right? Put in a bottom. Well, without having a lot of these big companies, what we've seen over the last 5, 10 years is that any sort of market volatility can spike really quickly, and it can kind of become a self-fulfilling prophecy. So you get nervous about tariffs, Jason. You say, I got to sell all my stock. You sell your stock. I look at what's going on. I say, wow, a lot of folks are selling their stocks. Prices are going down because of supply and demand. I unload my stock, and next thing you know, everybody's doing that, and it
Mhm.
snowballs. And in the past, the big market makers would step in, buy up those stocks at a discount, and kind of put that false bottom in. So without them, we've got these periods where we see extreme volatility, and the
Mhm.
markets can sell off really rapidly. And they tend to do that now based off of headline news versus the fundamentals. So when we look at the tariff war, it happened, in 2, 3 days. President Trump institutes tariffs on, obviously, China because of our history with China, but
Mhm.
then new tariffs on our neighbors to the north and south in Canada and Mexico, as a way of putting pressure on their governments, and with the goal of reducing our trade deficit. Well, they didn't blink. They came back and they announced their own tariffs. And that started a conversation about how reliant we are on Canada and Mexico for even products that we mostly think are domestic, right? So I was talking to one of my clients who has a brand new Ford Lightning electric vehicle. His car, most of the parts from his car came from Canada, and the car was actually assembled in Mexico. So it's a U.S. company, U.S. product with Canadian products, really, assembled in Mexico. If they start raising tariffs back on us, that puts a huge crimp in the overall economy. And so Wall Street looked at that and said, what's this going to do to prices, inflation, some of the earnings potential of our larger companies? And one thing to remember about the stock market is the stock market is a projection today of where we think these companies in our economy will be 3, 6, 9 months out from now. So when you start
Right.
imposing tariffs and what that might do to our economy, the markets are going to immediately sell off based off of what they think the future implications are. So I got into the office early Monday morning. I had a bunch of emails from some clients. Should we go all to cash? Should we do this? Should we do that? What's the downside implication? We ran some math and said, this is what you pay us to do, right? So we don't like to sit on our hands.
Mhm.
So as I mentioned, one of the best things you can do to get your plan to where it needs to be, is to protect against the losses. So we de-risked our portfolios a little bit, not all the way out because you don't market time and you don't jump in and out, but you do that. You have the conversation with clients, and then if we're wrong and this volatility that has been instituted by the tariff war dissipates pretty quickly or isn't that bad and there's not a larger market sell off, I'd rather be wrong by being a little bit more defensive than the opposite, where you stay fully invested, lose your shirt, and now we have to go back and adjust the financial plan. So that was a very long answer. I apologize for that.
No, it's complicated, and you explained it perfectly. Thank you for doing that. Um, yeah, absolutely amazing. So with your amazing the level of complexity in the whole system and just how the headlines can impact the market. And in your business, you're proactively making adjustments for your clients, right? So
Absolutely.
they're going to ask questions. I understand that. I do that myself, and they're going to be concerned. But are you essentially telling them, hey, it's like set it and forget it. We will take care of it. We will shift funds around. We'll make the adjustments to minimize that risk on any of the declines.
We actually have two conversations with the clients, right? The first is what we do for you as your advisor. So
Mhm.
we're not the set it and forget it types, because we
Okay.
do want to protect that downside volatility. So we're going to move around and we're going to tell the clients, hey, we'll de-risk the portfolios as needed. But what I do tell the client about is, hey, you have a financial plan, right? And that's a critical piece of everything that we do with all of our clients. It's to have a plan. And so the plan dictates how much risk we're going to take based off of their funding, ages, whatnot. And so for them, I want them to focus less about where we're doing and how much we've moved out of the markets, and more along the lines of, are you still on track to do all of the things that you want to do? And so mostly that's talking about retirement, but funding, juniors college, putting a new addition on the house, right? Having the money to hit all of your goals. Let you worry about that. We'll take care of the underlying investments. And the analogy I make as an amateur chef is that, it's like cooking a meal, right? If you ask me, Jason, to make you dinner, if we're getting together, have dinner, um, I can't do that. I can't make dinner unless I know, how many people are coming over. Do we have any allergies, right? What are your food preferences? So all of that information is the plan. The underlying investments or the ingredients, I can't shop for the ingredients until I know what the plan is, right? And so what we do in the markets and when we get in, get out, which stocks we buy, I try and get my clients not to worry too much about that,
Mhm.
because those are the ingredients that go back to that plan, right? That recipe that we're building and working for them on.
Got it. Okay. That's great. Thanks for explaining that. So, sorry, I'm going to pivot for a second because
Sure.
we talked about you being an amateur chef. What type of food do you cook? What is your
Uh,
favorite food to cook?
so I cook a little bit of everything. I married a wonderful Italian woman from Cranston, Rhode Island, so I've been big into making my own homemade sauces. I make a pretty
Nice.
mean roasted garlic cream sauce with some pasta. I do some Portuguese and Cape Verdean cuisine. So probably my favorite dish there is shrimp Mozambique. It's
Okay.
a spicy shrimp dish that we'll either have with garlic bread or served with rice.
Oh, that's awesome. Is there, I do love Portuguese food, particularly seafood.
Yeah.
Um, Not sure if I've ever had Cape Verdean food. Maybe I have and just didn't realize it. But
Well, that we'll have to go get lunch at one of the Cape Verdean restaurants in Pawtucket. There's quite a few good ones there.
I'll definitely take you up on that. Do you do any sort of like Italian Cape Verdean fusion?
I personally don't. So I say amateur chef because I have a brother who's a very accomplished professional chef. So we've had him do some fusion. We'll play like fun games, like my wife and I watch Food Network all the time. So we'll steal all of the different, ideas that they have on their game shows and put my brother through the ringer. So he made uh, when I lived in Dallas, Texas, he made a Tex-Mex Italian Cape Verdean fusion dish that was awesome. So I don't have
Oh,
that level of skill, but he can do it.
oh, that's pretty awesome. Very cool. All right, let's shift back and get more serious. So, you talked about the disruption, from the last financial meltdown, and now the concern around the tariffs. What does the investment landscape look like for the next 5 years? What are you
Yeah.
advising your clients on?
So, and this gets back to, again, like our viewpoint of what risk is and how to build it in a plan. The old way of building portfolios is dead. Most of what firms had done in the past was built off of modern portfolio theory, which is no longer modern at this point. I think even Harry Markowitz, the author of that paper, he won a Nobel Prize for it, will tell you that that's not the right way to think about portfolios anymore. So modern portfolio theory is all built around this idea that there's a certain level of risk that you're willing to accept, and let's build you a diversified portfolio to get you as much return as possible for that unit of risk. The problem is that theory was built on more of a stable type of portfolio design where you weren't really dynamically changing your asset allocation. And in 1952, the world looked very different, right? Globalization didn't have the impacts that they do today. So international had a different diversification benefit that it does right now. So for us, we're looking at an investment landscape. We still are diversified, so it's not like we're totally bunking all of the old modern portfolio theory, but we look at more factor-driven ways of investing,
Mhm.
momentum, technology, inflation, and we build a more active portfolio around that because that gives us our best chance of minimizing some of the actual market volatility. And then when we can get some upside, trying to get a little bit more of that. So I think um, the landscape in the short term is going to be interesting. It's really difficult to unwind what the future implications of this tariff war will be. And as President Trump has shown both in his term and also in 2016 and that administration, if the markets react violently to some of his policies, he'll adjust. He'll adjust on the fly, right? So we had a start to the day on Monday where our math said this thing could go down as much as 20%, based off of what um, what the tariff implications were and what the retaliation looked like from Canada and Mexico. And by the end of the day, we had already paused the implication of the tariff, the implementation of the tariffs for 30 days, right? So, what the landscape's going to look like, I think, is going to be a U.S. centric landscape for the short term. I'm worried more about where interest rates are going to be. But we're going to stay more US larger companies for now, stay nimble,
Mhm.
and trying to do our best to avoid some of these headline driven pitfalls.
Got it. Got it. That that makes sense, and that's good to hear. Um, how are you adapting, or how's the industry adapting to changing consumer preferences? So you've got different generations coming in. You've got
Yeah.
the generational wealth transfer, so going from boomers, and you got Gen Xers and Gen Zers, right, and so on. And they have very different goals when it comes to life and how they spend their money, and how they think about their careers and so on. Are you seeing any changes there, and how are you adapting to that?
We're seeing a lot of changes. As you can tell, I like to talk. I can get on my soapbox on this for probably another 45 minutes. So I'll try and keep it relatively brief. But um, the first is that shift in the generational wealth and what the priorities are of the Gen Z, millennials, even Zennials. Um, they value work life balance. They don't value money and investments the way that the baby boomers did. They don't necessarily think about retirement, and part of it is I think they have a healthy amount of skepticism about corporate America, but also where Social Security is. So they're more of an instant gratification type of generation where they're not necessarily thinking about the long haul. It's, I don't want to work today. I want to work from home. I want to do this and that. So um, as we sort of adapt to that, I think there's a couple of changes that have to happen. First and foremost is what are you delivering to the client and how are you delivering it, right? So there's not necessarily a need to have every client come in, sit down at a really expensive oak conference table that they ultimately paid for anyways, and have the stuffy conversation. I don't wear a tie anymore. I hope to never wear a tie again, right? This is about as dressed up as I ever get. So, the conversation and the deliverable to the client is different. It's
Mhm.
virtual. It's a lot more touching base with email and less of a stuffy sit down type of meeting for that younger client. Um, the other big difference is the product itself, right? So we changed our firm name, we rebranded a little while ago, and we got away from the term wealth management
Mhm.
and implemented or added fiduciary advisors to our firm's title. And the
Okay.
reason for that is twofold. One, we're fiduciaries, right? So when we get hired on, everything that we do is in the best interest of the client. You know, we're their CFO, basically family CFO, or if we're talking to a corporate client, we're helping them build their retirement plan. It's all about what's in your best interest as a fiduciary, but it's more than just managing wealth. It's also advising on all things financial. So when to take out a HELOC, how do you think about structuring the purchase of another business? How do you ensure and protect your current business? And those are things that we don't necessarily get paid for, but it's part of being a fiduciary advisor to the client. So that's another big part of this. And we're adjusting everything from the way that we visit with our clients and the frequency to how we charge fees. That's another old, stale part of the business.
Mhm.
The revenue structure for financial advisory firms is always tied to investable assets. And that goes all the way back to, the Wall Street boiler room, Wolf of Wall Street days, right? Where the guys were calling you up with a great stock idea and getting a commission on that. And eventually that great stock turned into, well, you need to be more diversified. So let me sell you this great mutual fund. And they
Mhm.
were getting commissions. And then at some point we realized it's not just about selling Jason this great idea, but giving them a full portfolio to help them meet their needs. And as the business evolved, we've moved away from just selling you on a stock to let me help you realize your financial goals. And our firm, we've just taken that and taken it to the next level. And we're not worried about, do you have $1 million to give us or $5 million to give us, and
Mhm.
tying our fee structure based to your investable assets, but our fee structure is tied to the level and nature of our relationship, the frequency of when we're meeting, and what kind of intellectual advice and capital we're giving you, and feeing clients that way in a transparent manner. Then you have 5 million, so I'm going to charge you X, and you have 50,000, which is too small, so I don't want to work with you at all. So that's how we're adapting, and I think that that's the future of the business. It's more of a holistic, advice-driven model that's not necessarily tied to how much money can you give me to invest.
Got it. Okay. Great. Very interesting. Fascinating. Um, let's shift a little bit and talk more about you. So, what really inspires you, whether it's in your personal life or in business?
Yeah.
Tell me what really gets you fired up every day.
So I'm all about my family.
Hmm.
And so what inspires me to do what I'm doing now is number one, I want to take care of my family. So I, think about my kids and building generational wealth for them and passing it on, and teaching them some financial literacy. Think a lot about my parents and the reason why we ultimately started the firm as a public benefit corp, doing the pro bono work, not having minimums, is that, as I mentioned, right, family of immigrants, my parents worked really hard, but nobody ever once told them to invest or do this, or hey, here's how you build a financial plan.
Hmm.
Mostly because they didn't know anybody in that space. And, if you don't have 2 million, no one's approaching you to offer up this advice. So for years, my father had avoided investing in the market because he just thought it was either a losing proposition or for wealthy folks. And they did really well for themselves. And we had a wonderful middle class upbringing. And now they're both retired, but they could have had that much more had somebody gotten to them 40 years ago to say, you should start investing, you should be saving for your retirement. So that's something else that inspires me. It's being able to have those conversations and help everybody.
Mhm.
Um, Before I started this company 5 years ago now, I worked for an institutional firm, which was great, awesome experiences. But I was traveling all the time, and it's hard on your body. But you also, I wanted to be around and coach soccer and help out at the nonprofit.
Mhm.
So I took what I learned, what I felt about where the business was going, how I could help people, and used all of that to start my own company to hopefully help more people, and then on the family side have a slightly better quality of life.
That's awesome. Excellent, and I think incredibly inspiring. So you went from you're working for someone else, you work for a more of a corporate institution, went off on your own. So congratulations on that. Um,
Thank you.
I know what that's like. What were
Yeah.
some of the yeah, what were some of the early challenges you faced in building or growing your business? Um,
So this is the hardest thing about being in the advisory space. It's a tough business to grow, and the best opportunity to grow is always going to be referrals, right? So people really need to know you, like you, trust you before they're willing to give you their financial future, right? Place that all in your hands. So in the institutional side, I didn't have any, clients that I could build a book off of and just steal and go, start my own company. Those were all institutions. It was a very different deal. So
mhm,
I knew what we wanted to build. I knew that it would most likely work. I didn't know how long it would take me to actually build it and get in front of people, right? And get some momentum and, start to get some referrals. So that was the biggest challenge. It's just getting in front of people. And there's a lot of different ways to do it. You can, work on your SEO and your online footprint and try and go about it that way. There's companies that will you can pay them and they'll build you leads. We all get all sorts of cold call emails and whatnot.
mhm.
So we did it the old fashioned way, 3 yards in a cloud of dust, and just talking to people and doing a good job for them, and then asking them to refer us to somebody if they thought that we did a good job for them.
Excellent. That's great. Were there um, were there any missteps you along the way, or any mistakes that you made that you can share that or valuable lessons for anyone else
Yeah.
on your own
So
journey?
I think I've got dozens of missteps, and we're still making them right now. I think um, one of the things that we probably should have done early on is not be so afraid to grow. So we had some, especially 2020 when we were starting the company. COVID, not an ideal time to start, but who saw that coming, right?
Mhm.
Well, what it did was create an environment that was very interest rate friendly, and we probably could have utilized some debt to grow a little faster earlier on, but we were afraid of that.
Mhm.
And so I think that when you're an entrepreneur and you're thinking about how to build out your company, don't be afraid to fail, right? Be aggressive. And if you fail, fail fast, right? Because then, you can go do something else, you can figure it out. So we were probably a little too slow to do some of the things that I we're doing now. I
Mhm.
could have done them 5 years ago and fast tracked a lot of things. So that's probably one of the biggest ones. I think the other thing too that every entrepreneur, small business owner runs into is that you're good at doing one thing or two things or whatnot, and not all of the things that you need to do to be a business owner. And so being self-aware and recognizing what you're good at and leaning into those and figuring out ways to either offload or hire or get people to do the things that you're not good at.
Mhm.
um, that's probably something that I try and take on like a lot of stuff, and I don't really like to outsource or delegate, and I wind up doing things that don't really make us money, don't make me happy, just get bogged down, and then I do a poor job of it, and I'm like, why am I doing this in the first place? So trying to do less of that is probably the second biggest mistake that we made.
So that translates into some good advice. Is there any other advice that you would give anyone who's thinking about going off on their own, starting their own business, taking that entrepreneurial journey?
Yeah. So do what you love, right? So the best thing I did, and the income took a hit, but being able to do something that I love, working for myself,
Mhm.
having and managing that quality of life was there's just it's you can't put a price on that. I think, and I talked to, we are talking about the differences in the generations, and I say that to all of my clients. I think one of the things that the younger generation has right is it really is about that work life balance, right? So being able to um, build and run a company that is kind of done in our image and benefits my family predominantly is awesome. So don't be afraid to do that. And it's well worth taking that risk. And as I was talking to colleagues and friends when I was thinking about making the plunge, one thing that just, they all kept repeating is that you should do it because even if you fail, right, that's a great experience. No one is going to not is going to look at your resume and say, oh, you started this firm and what happened there. And you say, well, I learned this. I learned a lot, realized I couldn't do this market, wasn't right for that. So we had to shut it down. That's the type of great life experience that's only going to help you get your next job anyways. So take the risk. One
Mhm.
other piece of advice though is if you're going to do that, make sure you have, and that I got this from one of my mentors, my old boss, who even though I was quitting the firm to start my own company, made as smooth a transition as you could possibly make. He kept me on as a consultant while I was still building my company out, kept me in so that way we could have, healthcare and benefits, and provided me all sorts of advice along the way. And one of the things that he said is just make sure that your whole family and your support structure is on board.
Yeah.
I couldn't do this without, my wife. We have a lot of sleepless nights, especially early on, where we're going to get the money to pay the bills. So if you don't have that right, family support structure around you, it's only going to add to your stress levels.
Yeah, I couldn't agree with that anymore. 100% on that. You're totally right. So that's some great advice. It resonates with me. I take it from you, and I think it'll be beneficial to the audience who watches the podcast. So I'm going to ask the last question for today. For anyone who wants to get in touch with you, connect, learn more about what you do, or they're interested in your services, what's the
Mm-hmm.
best way to do that? How they get in touch?
Sure. They can give me, I would say, give me a call directly. I,
Mhm.
uh, I guess I'm a millennial, kind of one of those crossover generations, but I'm old fashioned. Give me a ring. Let's talk about it. Let's, meet in the office or grab coffee or lunch. And I give everyone my cell phone number because it's just the best way to get a hold of us. So that's 401 230 2970. And just ask questions. When most folks are thinking about this, they have a lot of questions, and sometimes they're afraid to ask, "Can I do this? What should I think about this?" There's no bad question, so let's uncover. And if we can't work with you or support you, we'll normally know what you'll need and point you in the direction of that. So we've had clients that have come to us with questions that were more legal and estate planning. They fall under the purview of financial planning, but what we'll then do is help them kind of flesh out what it is that they're doing or thinking about, and then introduce them to the right attorneys or insurance broker for what they need. So we're always happy to have a conversation.
Awesome. That was excellent. James, thank you so much for sharing your story and insights with us. It was really inspiring. I think also educational, really fascinating. I think we could probably do several of these on a number of the different topics that we talked about. We just scratched the surface. So thank you once again. I enjoyed it. To our audience, if you enjoyed this episode, be sure to subscribe to the Get On Point podcast on YouTube and connect with me on LinkedIn, or you can email me at jmundy@focalpointcoaching.com. Thank you for tuning in, and remember, get on point, unlock your potential, and transform your business.